Good afternoon, boys and girls. Hope everyone's having a fantastic day. I am Raymond Dahlman, president of DSA Financial Group, and I am your humble host for the Liberty Call for today, Wednesday, February 9th, 2022. I hope everyone is having a terrifical day out there in the interwebs. It is another beautiful day here in Colorado. And I know I always say, how lovely the weather is here and how beautiful it is. So I'm just trying to make all my friends in Texas jealous who are probably either sweating or dealing with rain. The weather in Houston is just terrible. That's why I don't live there anymore. I mean, I love the city. I love, everything that it offers, from sports to terrific food. And I mean, you got the water, but the 100% humidity every day of the year, I just couldn't deal with it. It's just too hot. I mean, here in the house I live in here, I don't even have air conditioning. Granted, in late July, early August, the main floor is 85 degrees, but there's no humidity in the air. So turn on a fan, it's not too bad. And I mean, right now it's 44 degrees outside, sun, got a little snow on the ground. The house across the street from me has no snow on the ground because their front yard faces south. And just, that's the way it is. Like you look this way, it looks like Alaska. You look that way, it looks, not. Anyways. All right. Well, I hope everyone is having a good day out there. Pretty good day in the markets. Everything looks to be, appear to be up, which is always good. Granted, you shouldn't just judge the markets or the economy based upon, what one up or down day really is. It's, we're looking at the marathon, not the sprint. So, all right, let's go ahead and jump in and see how the indexes did. The Dow Jones was up 0.86 today, closed at 35,768. S&P was up 1.45, closed at 45.87. NASDAQ up 2.08%, closing at 14,490. Small caps are up 1.57. The VIX was down 6.9%, down to 19.96. That is a good sign. So granted, I know I keep saying we're to expect some sort of a downturn or a bear market or whatever you want to call it. But it is good, for the short term that we have some reduced volatility. It certainly helps with the indigestion. All right, across Europe, all green. Let's see, the first red we get to is the Tata Wool All Share. I have no idea where that is. Saudi Arabia. And all green all the way down across the Asian markets, and until you get down to the CSE All Share, and that's Sri Lanka. So, but all in all, a pretty good day. Starting out in the Asian markets overnight, lots of greens, lots of 1% and 2% up. Same thing in Eastern Europe and Western Europe, lots of greens, got some 2s and 3%. So, if we were to judge things by today, seems pretty calm, even with all the, the bad news, or I don't know, really bad news, but the news of what's going on with Russia and Ukraine. I personally think it's a lot more of wag the dog, like the movie from the late 90s. It's just a distraction from everything we've been dealing with. Same thing with the COOF, the fake cold we've been dealing with for the last 2 years. It's just a way to fleece the taxpayer, in my opinion. But hey, what do I know? All right, got a couple articles I want to breeze through today. Wall Street ends sharply higher, lifted by big tech. This came out, this is from Reuters, written by Noel Randowich and Bansari Mayor Kamdar. I apologize if I screwed up your name, brother. All right, or sister, that could be a girl's name, I don't know. Wall Street jumped on Wednesday, closing sharply higher as mega cap growth stocks powered up thanks to a pause in rising interest rates, and upbeat earnings reports also encourage investors to buy. The benchmark 10-year U.S. Treasury yield slipped from multi-year highs hit in the previous session, helping steady sentiment across global markets and boosting demand for growth stocks. Meta platform surged, ending 4 sessions of deep declines that saw it lose almost a third of its value. The biggest boost to the S&P 500 came from NVIDIA and Microsoft. Real estate was among the strongest of the 11 S&P 500 sector indexes. The bond market basically is saying there's a cap or a limit to how much the Fed is likely to raise rates. And that's a very positive for stocks in general, and especially for growth stocks tend to be valued higher, said Tim Grisky, senior portfolio strategist at Ingalls and Schneider in New York. Hit by worries about rising interest rates, the tech-heavy sector, NASDAQ has fallen almost 8% so far this year after gaining nearly 21% last year. Unofficially, the Dow Jones Industrial Average rose 0.86 to end at 35,768, while the S&P gained 1.45%. NASDAQ was up 2.08%. We just said that. Investors will watch consumer price data on Thursday for clues on the Federal Reserve's plans to hike interest rates, and an unexpectedly strong jobs report last week raised concerns of a more aggressive move by the central bank. Inflation is forecast at a 4-decade high of 7.3%. U.S. economy may be nearing a slower pace of inflation. Atlanta Fed President Raphael Bostic said on Wednesday, though he added he is still leaning towards a slightly faster pace of interest rate increases this year. Of the 360 companies in the S&P 500 that have reported earnings to date, 78% reported above analyst expectations, according to Refinitiv data. Chipotle Mexican Grill surged after beating profits and sales estimates, while KFC parent Yum Brands rose after sales beat estimates. Emphasis Energy jumped on upbeat sales, lifting the solar stocks like SunPower Corp and Solar Edge Technologies. And get out of the way. CVS Health slipped after its earnings forecast for 2022 fell short of Wall Street expectations. So I think a lot of the uptrend in today's market primarily is due to the just upbeat earnings. Earnings look good. People are more apt to push a little more cash into the markets. So that would probably be my my guesstimate on that. I would say that they keep where was it? They keep talking about, well, the rising interest rates. The Fed's trying to figure out what they should do. I'm sorry. These people are full-time economists. If they do not know what they've done and how they've screwed stuff up, I'll keep it clean. They should all be fired. I mean, if me with 35 hours of college under my belt and a couple of econ classes and reading a lot of books and listening to a ton of podcasts on economics, primarily Austrian economics, the only way to go. It's. I mean, these people had to have known 2 years ago when they were pouring cash into the economy that this was going to lead to high inflation. I mean, seriously, are people just that stupid that, we're not really sure what we're going to do? You know what you have to do. You got to raise interest rates up to quell the inflation. If you don't do it, we're going to wind up having a decade like the 70s. And, granted, Jimmy Peanuts is still around. Maybe he could give us some tips on how to survive stagflation. So, all right, next article. Even if this is a bond bear market, things may not end badly. This comes from Bloomberg. The question of the day is whether we're in a bond bear market. After all, we don't even know what one looks like. It was on record a month ago, or I was on record a month ago saying 2022 would see a prolonged downturn. So I think the answer is yes. We seem to be in a bond bear market. That means there are two important episodes to keep in mind now: the 2013 taper tantrum and the bond market massacre of 1994. My interpretation of the taper tantrum is that bond markets were getting in front of an anticipated tightening in U.S. monetary policy, causing yields to spike and the weakest emerging markets to suffer. But in 2021, when the Fed first started talking about tapering, it explicitly said there was no discussion around a rate liftoff. So front-running hikes via a taper tantrum didn't make sense. That changed last year. In early December, I said that a taper tantrum was on the table for 2022, centered in credit and emerging markets. And we have already seen the initial sell-off in credit. But despite all the headlines and the angst, things are tame so far. We've seen worse, even in the last few years, namely in December of 2018 and March of 2020. It will only become a tantrum if the Fed further accelerates rate hikes. Then there's 1994. This year was a lot worse for developed markets than the taper tantrum. The Fed was more secretive back then and totally surprised the markets by jacking up rates soon after the slow, so-called jobless recovery ended. Friends of mine found offers from investment banks were suddenly rescinded and people were getting sacked in droves on Wall Street and in the city of London. It was a very ugly period in the bond markets and for job security. Something I don't recall because I was serving in the Navy at the time. So in 1994, I was pumping oil into the engines of F-18s, filling them up with gas, and I was a plane captain also. So Did a lot of manual labor back then, so I couldn't have told you anything about what was happening in the bond market. God damn, that was almost 30 years ago. All right. But if you look at the treasury markets, the 10-year path tells four stories. First, just like 2020, there was a massive monetary easing as 1991 began. Commercial property and high yield markets languished, and the cleanup after the disastrous savings and loan crisis was underway. 10-year treasury yields dropped 3 percentage points during that time. Then, just as in 2022, in 1993, policy changed overnight, but back then the Fed didn't telegraph forward guidance, causing 10-year yields to move up almost back to early 1991 levels. That's a massive amount of tightening and not analogous to the taper tantrum. Third, bond market carnage doesn't mean recession. The Fed subsequently pivoted and yields came right back down. By 1996, we were 2.5 percentage points lower on the 10-year and set the stage for 5 back-to-back years of 20% plus gains for the S&P 500 index, and then for the equity bubble that later grew out of those gains. Lastly, if you look at spreads, despite the decline in yields after 1991, there was a massive curve steepening that helped banks rebuild capital, which aided recovery via credit supply. But notice that when the Fed crushed the bond market in 1994, duration spreads collapsed and didn't recover for the rest of the decade. Moral of the story is that while we're having another bond bear market in 2022, it doesn't have to end in a big crisis or recession. The taper tantrum was less destructive for developed markets than what occurred in 1994. And even in 1994, the US avoided recession and went on to stellar growth for the rest of the decade. But of course, not all bears are created equal. So also what happened back in the early to mid 90s was that President Clinton, for all of his horrible faults, actually had a balanced budget, and we were actually paying down the national debt. So having a more fiscally responsible government, paid some larger dividends for the next decade or two. Granted, then W came in and started a bunch of wars in the Middle East and jacked up our debt. So again, we're dealing with these problems now that were created 10, 20 years ago. All righty. So got an article here on the Fed. Fed Mester says case for a 0.5 percentage point rate hike in March, not compelling. This is written by Jonelle Marte. The Federal Reserve will have to move faster than it has in the past to remove accommodation or tame inflation that is well above target, but it may not be necessary to start the liftoff in interest rates, which a 0.5 percentage point hike in March. Cleveland Fed Bank President Loretta Mester said on Wednesday, inflation could ease to above 2% later this year as some of the constraints on supply are resolved and the U.S. Central Bank removes some of the support it provided to the economy during the coronavirus pandemic, Mester said. I don't like taking anything off the table, Mester said during a virtual event organized by the European Economics and Financial Center. But, I don't think there's any compelling case to start with a 50 basis point rate increase. Mester, who has a vote this year on monetary policy decisions, said rate increases are going to be in play at each Fed meeting, and further hikes after the March 15-16 meeting will depend on the strength of inflation and how much it moderates or persists. Referring to the Fed's balance sheet, Mester said the central bank needs to move faster to reduce its nearly $9 trillion portfolio than it has in the past, and that it may need to consider selling some of its mortgage-backed securities. The Fed said last month that it wants to take primarily passive approach to shrinking its portfolio, but Mester said it may need to sell some of its mortgage holdings to meet its goal of having a portfolio that invests mainly in treasury securities in the longer run. I would support selling some of the mortgage-backed securities at some point during the reduction period to speed the conversation of our portfolio composition to primarily treasuries, Mester said. Asset sales wouldn't necessarily be the first step for the Fed, but rather something to consider later on for mortgage holdings because the treasury securities in the portfolio have a shorter duration and are likely to run off the balance sheet quickly, she told reporters. So, while I completely disagree with Ms. Mester's opinion on a 0.5% rate increase, I think I would probably go a percentage myself. Just slam the brakes on inflation. Consequences be damned if some people lose some jobs. Oh, well, we could probably cut some spending at the federal level and help out everybody. But I do agree that, reducing the Fed's portfolio balance, they've added about 4 to 5 trillion in the last 2 years. I think that's going to have some ripple effects, whether or not, because if you're selling them out back into the open market, it's going to push down the values of those that are still out there in the markets. So they've got themselves in a pickle. So, all right. Next article has to do with oil. Oil rallies on big drawdown in U.S. crude stocks and strong demand, written by David Gaffin. Oil prices rallied on Wednesday after U.S. crude inventories dropped nearly 5 million barrels and fuel demand rose to an all-time high, underscoring the market's ongoing tightness. So let me stop there. If you remember a couple of days ago, I had an article where I was talking about they were expecting a not a drawdown, but a oversupply, basically meaning that they were going to add to the supply of oil. And God, these analysts are just terrible. We're $5 million barrels, in the negative when you thought you were going to have a greater surplus. So it's hard to tell, what's good news and bad news when a lot of these analysts can't get their stuff together. So, all right, Brent crude, which settled up 77 cents or 0.9% to 91.55 a barrel. WTI ended up 30 cents to $89.66 a barrel. U.S. crude stocks fell by 4.8 million barrels last week to 410.4 million barrels, their lowest since October of 2018, while overall product supplied, a proxy for demand, hit a record 21.9 million barrels per day over the past 4 weeks. Government data showed the heavy activity and ramp up in U.S. refinery processing augur for a tight market for the coming months. The data was decidedly bullish, hands down. Everything was bullish with inventories at their lowest in years, said Phil Flynn, analyst at Price Futures Group. The market has also been supported by concerns about the ongoing threats and supply in the UAE, which has been hit by attacks from Yemen's Houthi group and over Russia due to the presence of thousands of troops near its Ukrainian border. So let me stop there about the whole Ukraine-Russia thing. Russia and Ukraine share a border. So Russia can have all the troops that they want on their side of the line. So, I mean, to say, well, my God, there's thousands of troops, within, 3 or 4 hours of the border of Ukraine. Well, that's like saying there's, hundreds of thousands of Texans, within the border or near the border of Mexico. Well, duh, because people live along the Rio Grande. I mean, come on, people. Sorry. Let's see if there's anything else there. Yeah, just again, I was hoping to see more of more relief in oil prices, but it just doesn't appear we're going to get that anytime soon, especially as things start to warm up over the next couple of months. We really need to get more rigs on supply. All right, and a bit of good news. Well, I say that sarcastically. U.S. confirms highly pathogenic bird flu at Indiana turkey farm. I mean, what was it, 2-3 weeks ago? You had that monkey truck. That truck full of lab monkeys flip over in Pennsylvania, and a dumbass woman goes over to see what's inside the cages and gets spit on, and then she gets pink eye and some sort of respiratory disease. I'm waiting for monkeypox to come out and start killing us all. All right, this is written by Tom Polensek. The U.S. Department of Agriculture on Wednesday reported an outbreak of highly pathogenic avian flu in an Indiana turkey flock, the nation's first case in a commercial poultry operation since 2020. Well, I guess it happens more often than we know. Cases of the disease, known as bird flu, can hurt the U.S. farm sector because poultry are killed and trading partners can limit imports from infected areas. China said on Monday it banned imports of poultry from Spain and Moldova due to outbreaks. Bird flu does not present an immediate public health concern, said the USDA said. About 29,000 turkeys at a farm in Du Bois County, Indiana, in the south of the state, are being culled to contain the outbreak, which was confirmed after 100 birds recently died, and state officials said. Indiana said the strain of the virus was H5N1, and that it was the state's first case of highly pathogenic bird flu in commercial poultry since 2016, when 40,000 birds were killed. The H5N1 strain has also been found in wild birds along the U.S. coast, U.S. East Coast, and caused a wave of outbreaks in poultry across Europe and Asia. The outbreak in Indiana is significant because it indicates the strain has entered a migratory pathway for birds called the Mississippi Flyway, said Jim Sumner, president of U.S. Poultry and Egg Export Council. The pathway includes major poultry producing states such as Mississippi and Alabama. The H5N1 strain has been wreaking havoc on Asia and Europe. Sumner said, "We were hoping we could avoid this, but it's apparently in the flyways." Sumner said China will likely ban imports of poultry products from Indiana for 90 days, while Mexico will likely limit shipments temporarily from Du Bois County only. Indiana is the third biggest U.S. poultry producing state, number one in duck production and number two in table eggs and egg-laying chickens, according to the state. Officials quarantined the infected farm and said birds from the flock will not enter the food system. They are testing birds in the surrounding area for disease. So that is some terrific news. I mean, great. I mean, we got potential monkey disease. Now we have another bird flu. I mean, come on. I think that the world's trying to kill us. I think what we should probably do to help with all these bad problems is maybe have some sort of treatment for the woke. Maybe round them up and put them in a place and so that they get rid of all their dumb ideas. But I'm not too hopeful about that. So, all right. Well, that's everything I had for today. I hope everyone has a terrific evening. And I think the U of H is playing tonight, I believe, probably 5 or 6 o'clock my time. So for all the Cougar fans out there, let's wish our boys some luck. They've won like 12 or 13 in a row. And I've managed to watch almost every game this season, which has been nice. All right. Well, that's everything I had. And I'll be back tomorrow with the Liberty Call for Thursday. Have a great evening. Bye-bye.